Hi, this is Julie at InSmart, and I am going to be showing you how a classic Wealthy and Wise case is built within the system. The video is going to be accompanied by a PDF file, which is going to be included in the link as additional material. Okay, so this PDF file is basically manual, and it is made up of two parts. The parts that are for the Wealthy and Wise case are located from page 60. So it's a pretty big file, 116 pages long. The information and the reports that are produced by this case are contained from page 60 to page 116. The basic data for the client that I'm going to use in this example is located on page 73. Okay, so these are the made-up data that I will use for this case. And for a 60-year-old couple, they have $500,000 in taxable accounts, $500,000 in tax-free account, and another $500,000 in equity assets. And then they also have an RA that's got about $600,000. So this is the basic data. They have a house. Okay, so the study is done to do a cash flow analysis for this couple, and also to find out if it's going to make sense for them to do a Roth conversion. And also, we're going to analyze whether adding an IUL insurance policy as part of their retirement plan is going to create additional benefits or not. Okay, so that's the basic structure of the case. And I'm going to basically start getting these data into the Wealthy and Wise system and show you how these analyses are made. Okay, so if you want to reproduce this case on your own, you can open up the file to page 73 and see if you can build this case on your own, and can you get results that are close enough to this. And it's a nice way to practice creating a case. Okay, so first we open the system by clicking on the InSmart system shortcut on your desktop, and then launch the Wealthy and Wise system. And we're going to create a new client workbook. And the client's names are Robert and Ann Baxters. Okay, so I call them the Baxters, or you can call them the practice case. And I put, so like that. So the client's name is Robert, and this is the husband, and he is 60 years old. He plans to retire 10 years later. And then the wife's name is Ann, and I assume she's also about the same age. Okay. Tax bracket, I assume to be 31% tax rate. This is pre-retirement years from age 60 to 70. And then the same when they retire, starting at age 70, 10 years later. Okay. You use in your own case whatever the actual realistic number. Okay. And capital gains tax rate is assumed to be 20. That's fine. And I'm going to run this analysis till age 100. Okay, so that's the basic client data. Click OK to save. So you move to the next step. And now we're starting from scratch. So this is the very first scenario, and I call this the baseline. And it is basically a cash flow analysis, a financial checkup. Okay. And the first scenario, the baseline, the starting point, is going to be most time consuming because you kind of need to add the numbers in. Once you build the first scenario, the second and the third and the later scenarios are going to be a lot faster to create because all you do, you copy the first one and make some modifications. So you don't have to redo a lot of the numbers. Okay, and you go through these tabs. First tab is desired cash flow, include, green check, okay? And then cash flow options right here, by default is this selection, but generally speaking, I think it is a good idea for you to pick this one, okay? Show cash flow as either spendable or dedicated. And the reason to do this, to choose this option, is so that we can differentiate money that's truly spendable, like, for living expenses, for buying grocery, for whatever that's going to be spent. That's the cash flow that's spendable. Sometimes when you do a plan, for example, when you do a Roth conversion, and also when you do an insurance proposal, if you pick this one and you do not distinguish it and lump everything together as spendable, it's going to create in certain reports numbers that's kind of skewed, okay? Because if you're going to propose an insurance policy, for example, you add, the premium. Let's say it's 50,000 annual, and their lifestyle need is 150,000. The spendable is 150,000. The dedicated cash flow is that premium, which is not really spent. It's actually buying and investing in the insurance, and it is distributed. It's funded by distributions from their assets. So it's kind of an asset reallocation, and that's why I want to distinguish these, and it will show up in certain reports. So generally speaking, I would suggest use this one, okay? This is located under desired cash flow, okay? So now, what do they want to have available to spend? Okay, living expenses, spendable and schedule, and they're going to retire in here, so in year 11, and they want to, their lifestyle need is about 150, so I equal all the way down, okay? And I'm going to add inflation. I will start the inflation actually in year 11 instead of from year one. Because if you do 3% from year one, this number is going to grow to a giant number by age 100. And that's not what I decide to do. You certainly can start the inflation right here, 3% and apply. And it's going to, apply the 3%. And in year 11, this 150 is going to be a lot higher than 150. But in my case here, I just happen to use an input like this. I want to only start the inflation starting in the second year. So year one, their retirement need is 150, and it's going to then be inflated at age 71. Okay, starting here, and then you do need to click on the apply. So I'm doing actually two steps in the inflation rate, okay? And I click on apply, watch this column. So 150 to start and then gradually increasing by 3%. and it's going to grow to about 364, so double. Okay, that's the desired cash flow. And I set up the case assuming when they are still working in year 1 to year 10, they're making their money from business or work, and we're not concerned about their lifestyle needs. So I'm not doing pre-retirement cash flow analysis. The objective of this case is about what happens once they retire. Depending on your case needs, you could do from year 1. You could add 150 here all the way down, okay? But for me, I think the focus for this couple is clearer if I ignore these pre-retirement years, so I don't have to deal with, their income and how much money they're making, how much they're spending, do they have extra, where is it going to? So I ignore all of that. I'm, working with certain setup data. Sometimes it's better to ignore certain unnecessary information. Okay, so this is about post-retirement years. 150,000 starting year 11, index at 3%. Click OK to save. And next we deal with expected cash flow, retirement plan assets, which is for qualified accounts, and liquid assets, which is for non-qualified liquid assets. These are the 3 areas where you input the client's liquid pools of money. So where will the money be coming from to cover the needs? First one, deal with expected cash flow by clicking on include. And when people retire, they're going to have Social Security. So you select that, schedule, and they don't know exactly how much money they're going to get from Social Security. So we rely on an embedded calculator right here. In your case, if people are already retired and they know exactly from their statement how much Social Security they're getting, you can directly type in the numbers, okay? In net numbers, you have to figure out what the taxes will be and then enter the net. Don't enter the gross for Social Security. Here we're, projecting 10 years away, so I use this calculator, okay? And then I'm going to input the information about them. So he is 60. So let's say, and then she is, let's say, 01, 05, 1960, 59. Okay. And they're going to start the benefit late. So to maximize it, okay. And while he worked, his annual income is at this level, exceeds. And she also makes a good income. So if she makes less than 132,000, you could add this, let's say she makes 100,000, okay? But in my case, I assume she makes over 130, and their retirement income would be over 44,000 threshold, which means that Social Security benefits will be taxed, okay? So that's the assumption. After you complete these input, you click OK, and it's going to populate these columns now with the after-tax Social Security benefit. So complete your input, click on OK, and now it says, okay, his and her Social Security benefits are estimated to be 64,000. And I add like a 1% and apply, and it's going to grow to this. Okay? This is the Social Security benefit. And if people have rental property income and other income sources, not liquid asset, not distributions, but just income sources, you add them here. Okay, let's deal with qualified account. He has 600,000 in the RIA. So you go to retirement plan asset, defined contribution for client, for Robert, include, and I'm adding 600,000. Okay. Management fee, I assume 0.5%. Yield is assumed to be at 7%. Okay. So, and these input field has a lot of little details. So I think it's going to be worth your while to actually look at all of these input boxes, okay, to see if you need to use them. So they don't have a Roth, and they don't have defined benefit, which is a traditional pension. So the only thing that I'm dealing with is the RA worth 600,000. Next, now I'm going to move on to non-qualified liquid assets. First one is taxable, and you could name this, like BOA or something account or something, okay? And then it's 500,000, so they're highly liquid, and let's say it's earning 4%, and I'm not adding any fees in here, so this is the 500,000. Next, they have a tax exempt, tax free. So you could call this muni or specific names, okay? Or you can leave it blank. So 500,000, okay? And it's earning 3% tax free money. So that's the tax. Next, we deal with equity account, brokerage account, and this is also 500,000, and I assume cost basis 400,000. Okay, and they're not adding new money to the account. So there are people who are still saving. You can't check this and add new money to the investment account. Okay. Let's see. So dividend rate is supposed to be 1% here. The tax rate is 20% on this 1% earning. Capital growth is 6%. And management fee, I add like maybe to 0.5. And portfolio, so I'm going to use 50% as long term. Portfolio turnover doing relatively conservative, okay? And that's it. This is about the equity account. Now they also have a house. So I'm going to add under illiquid asset, add principal residence, and it's a $500,000 house, okay? And let's say it's appreciating at 5%. Now, if they have mortgage still remaining, I can illustrate a loan, and this is an amortized loan, and let's say it's got 150,000 loan, and how long? Years remaining. Let's say it's got 10 years remaining. Interest is 4%. So if you need to deal with mortgage, that's how you do it. But in my example, I am not showing any loans at all because it's assumed the house is paid off. And notice this, refinancing, sale out of the house, upsizing, downsizing, or boxes that's available for you to click on if you need to, okay? So that's where it's located. Here, the simple input is they have a house, 500,000, and it's all paid off. And then let's say they have some additional illiquid asset, and it could be vacation home, rental, or some personal property. Could be art collection, whatever. So let's say they have a personal property, kind of a generic name, and it's not really earning anything. It's actually a depreciating asset. Could be a car or something. So to simulate what happens with an asset that's actually depreciating, you can use negative growth. Okay. And that's about it. You know, when you look at page 72 of the PDF file, this is the basic asset and income and expense details about this couple. And you're ready to look at the reports, okay? Other asset is used to show insurance kind of asset. If they have an in-force policy, you can add them. They have a term policy, you can add the death benefit. But here they don't have it, so I skip this. Last tab is for illustration details. And when you click on this, you get these subcategories showing up. Excessive cash flow and reinvestment options. It's a good idea to actually always pick one of the liquid accounts. Okay, so what's showing up is the liquid accounts that you've entered under here. And it is used only if in any given year there is extra income that they don't spend. So in some kind of a scenario when, for example, when a client has a huge RA and they've got other sources of income, and the RMD is going to be forced out, and that can create a scenario where their income total is going to exceed their expenses. So if they want 150,000, somehow they get 200,000. You need to make sure under illustration details, this section, check one of the accounts. You could do 50% here, 50% here, but you do need to not ignore this input. And it is only used when it's needed. Last one is prioritize the use of assets. And this is where you can do smart distribution analysis for your clients, okay? On the left side, out of the three options, you do need to pick one, either this one or this one usually, okay? So let's say we pick the sequence order, okay? So we're saying out of the liquid assets, we're going to use one asset at a time and then rely on this in built-in calculation to figure out the smart way to use the liquid asset. So you click on maximize net worth. And it's really went very fast, but it did test for you every kind of possible combination. And then this is the smart distribution order as determined by the software. Because we can now go look at the report. And that is, there is one report that you want to specifically look at, which is hypothetical net worth. Okay, add this one, and then look at this. And it's going to give you this kind of report that shows you year by year, after they get their 100,000 to spend, what's left. So it's liquid, illiquid, everything added together after they get their lifestyle need covered. So here in year 40, at age 99, this is the total, okay? Hypothetical net worth total, about 6.5 million. So it looks really good based on the smart distribution analysis. Now, if you close off the report and back here, and if you shift the orders around to randomize it, does it actually produce less money for them? So it's our way to test and see if smart distribution order is going to actually make any difference for them, okay? Nothing else is changed, only how you use the asset. And then you go to the same report selection, look at the same number, same report. And you see here, out here, was their left was only 4.4 million versus 6.7 million. So it is something that needs to be looked at, okay? So we suggest that you always do this when you do these cash flow analysis for clients. Sometimes it doesn't produce much of a difference People don't have enough money no matter how you work it, but sometimes it can produce a huge impact. So always do this. Look at that report and then come back here, shift things around, randomize it to see a poor way of distributing the money. Does that actually create less money? And it is a way to build a case so you can prove to the client that smart distribution analysis is a very important um, factor to consider when you do wealth planning and retirement planning. Okay, so this is based on smart distribution, and you get cash flow analysis and so forth. There's going to be a lot of reports. Okay, and basically, you've got your first scenario made. This is a financial checkup, and it's going to tell you, are they going to run out of money or are they going to be perfectly fine? How much is left? What are the taxes and so forth? So there's a ton of reports. And you click on Done to save. It's a good idea for you to preview all of the reports, okay? So you know what's going on with the results. Click on Done, and now you save the baseline. We did the first scenario, and this is the age. So let's say I change it to 94. See the numbers change. Okay? Okay, so what's next? I want to build a second scenario because this couple has a large IRA, 600,000, and I want to test for them whether Roth conversion is going to be a good idea. What's the cost and benefits of doing that? So I'm going to now copy the baseline and rename it to Roth conversion, okay? And you can copy by clicking on the new button. Either copy or new, either of these buttons will give you the option to copy. I like to use the new button to build a second scenario. And I click on new, and you see you can either create the second scenario from scratch or copy, okay, the existing first one. So I'm going to copy the baseline and rename it. The second scenario is going to be Roth conversion. Okay. Okay, so right now I have an identical copy of the first one, but I am going to make one change to make it into a Roth conversion study, okay? So do not change anything else other than under retirement plan asset. You see he has a 600,000 RA. Don't change anything here, but then add one more input under Roth defined contribution for him, for client. This is the new input for the second scenario. And I'm going to add an include button and then pick this one. Client does not have a current Roth, but intends to convert. Okay, so I pick this choice. After the money has been converted to Roth, it's going to be earning 7%, and the management fee is 0.5. Okay, so I am going to use identical yield assumption as in the defined contribution RIA. Okay, this is on the Roth money after it's been converted. And then one more input. You need to come here under Schedule Roth Conversion and click on the Schedule button. Okay, and you need to determine how much of the 600,000 is going to be converted, and how do you convert it? Do you convert the whole lump sum? That's going to be kind of crazy, it's so that's not what I'm doing. I'm actually going to do 80,000 because I have some years to work with before they retire. They have 10 years. So I'm going to actually go just basically convert this thing for about 10 years, 80,000 until the account goes down to 0. Okay, so it seems that it's going to be able to do about 10 years. Okay, that's how I deplete the account. And it's going to incur this kind of income tax cost on the conversion. 31% income tax on 80,000. This is the cost of doing the conversion. Okay, so now up here, there are two sections for input, and these are important. I have heard from producers who say their income tax in some way is going to be less than if they do the conversion. So, you know, these clients' income tax rate is supposed to be 31%. And I'm just using the system to figure this out, 31% of this. If in your case, you're going to use a different income tax rate, either higher or lower, you pick this, okay? So let's say for whatever reason you could find some magical way of only incurring 21% on the converted part, you do this, okay? All right, or it could be the opposite where, it increased the income taxes because they have higher income due to the conversion. So you only use it if you need to, and it's hidden under here. What I'm using is actually I'm just using the 31%. Okay, I assume it doesn't create a higher tax bracket for these people because I'm taking out 80,000. Okay, and now the next question is dealing with the payment of this income tax bill. Okay, you could specify exactly which liquid asset is supposed to be used to cover this. Okay, and if you click on this, it's going to give you all of these options, and you select one from the liquid account. Okay, I like to use this because this has got the smart distribution analysis applied. So basically, when you pick this one, it means when the program looks for the money to pay the income tax, it's going to look for the least efficient account to pay the income tax bill. Okay, so we get 100% of the money showing up in the Roth. Okay, so we don't want to show 80,000 minus 24,800 as the amount showing up in Roth. Okay, sometimes you don't have that option because the clients may have all of their money in a big RA and they don't have other liquid money available. Then you have to reduce the amount that's going into the tax exempt Roth. Okay, but in other scenarios, pick this option and the program, I would say just use this one by default, okay? And the program is going to look for the least efficient money to pay the income tax bill. Okay, so after you completed all of these input, click on OK, and you've got the second scenario made. So the only change that I made to show Roth conversion is right here, okay? Add the new input, and you're going to have a whole set of reports and so forth. And for example, you're going to see in the cash flow analysis now, this is the income tax due to the Roth conversion. This was not here in the first scenario when we didn't do the Roth conversion. They're just going to wait until they retire and they get their money to spend. Here, we created a cost, a new expense that happens right now, okay? And the money is coming from the taxable tax exempt account, okay, to cover the taxes. And then you're going to have Roth showing up. This is the new report, Roth. We're adding 80,000 into the account, into a great tax-free vehicle, and it's going to grow to a great tax-free account, okay? The defined contribution account you see here, we're draining it 80,000 every year and then till it's all gone by year 10. So we converted all of this money, which show up as deposit into the Roth. Okay, so all of the reports are going to be showing you where the monies are coming and going, and it's a good idea for you to look at all of the reports. Okay, so now we've got Roth conversion done. You see here, at age 99. Look, we created, so I can see already from the first look, there's a nice difference in net worth. We've added more money and more wealth to heirs. So earlier years, probably it's not. So let's say at age 70, you see that in the Roth conversion scenario, in the earlier years, the net worth is actually lower in the Roth conversion because there's that tax due to the Roth conversion. But then it gradually picks up and then it becomes better. Okay, so that's the Roth conversion. And once you've made two scenarios, you can actually do comparisons down here. But before I do comparison, I want to add one more scenario, which is I want to see if adding an insurance proposal, an IUL product, is going to make it worthwhile for them. Is it going to be too costly and thereby, producing less wealth, or is it actually going to be a good deal for them? So that's what I'm going to do. Now I am going to copy the Roth conversion scenario. I don't want to copy the baseline because the insurance is going to be added on top of the Roth conversion. So I click on New and want to make sure it pick the Roth conversion to copy. So it's Roth plus IUL, okay? So now I want to build this third scenario. And it is going to be here that we add a new input, okay? And all I do is go to other assets, add, include other assets, and this is inside the estate. I want to add not the current insurance, but the proposed insurance. So proposed life insurance, schedule. And now here you can import the source data, which is information you get from insurance company, and you need to know how to get it into the source data. Okay, so let's see, where is the policy? I have it in my source data, and let me search by name. It's Robert Baxter. Right here. Okay, so this one. Okay, I have already saved it and imported the source data in my source data storage file, so it's ready for importing. And the policy looks like this: 50,000 10 pay, producing 50,000 retirement income. Okay, and then it's got the cash value, death benefit, and so forth. So this is the policy that I'm going to propose. See, I got it imported. Okay, everything shows up. This is the additional dedicated cash flow. And then there's the retirement income in the form of loans from the policy, cash value, surrender value, death benefit. Again, let me show you how to import it from source data. All you do, you click on the import button. You get to now the source data storage file. Find the policy that you've already saved in here. Pick, select, okay, highlight it, and then click OK. The whole set of data comes through. Okay, click OK to save. And now you've got a new scenario made, and it looks like this now. Cash flow needs now is going to be 24,800 for the Roth conversion plus 50,000 insurance premium. Okay, so this is the new cash flow. So basically the needed money, okay, that you need to spend by doing the plan. This is the cost of doing the Roth conversion plus the insurance. And it's going to produce retirement income from the policy, from the IUL. This is the tax-free policy loan from the policy. Okay, this is the income distribution. This is the Social Security. So this is the new numbers showing up in this scenario. And there are going to be other information that shows up, okay, in multiple reports, like death benefit shows up in the wealth transfer, net worth. Let's see, does it show? Now, see, net worth shows now, in addition to liquid, illiquid, insurance cash value, it's part of the net worth, okay? This is also a new column that shows up. And you click on the dump button, now you've got 3 scenarios made, okay? So baseline, second step, Roth, and then an insurance plus Roth, okay? And you see here at age 99, let's see, it looks pretty good. And now you can do comparisons by going down here, and you build your comparisons by clicking on this new button. This new button keeps on making new scenarios, okay? Comparisons are only possible to make once you've got 2 or more scenarios. So now I have 3, I can do a comparison by clicking on the new for comparison. Okay. And then you pick which comparisons, which scenarios you're going to compare. You can do 2 or 3. So right now I'm going to pick the first one and make sure the text underneath it is consistent with your scenario. Okay, so this part, and then second scenario is the Roth, and I do this. Okay, and third scenario is Roth. If you want to only do 2 scenarios, you just pick this one, and then it's going to be 1 against 2. But here I want to do all 3 scenarios. So last scenario, which is the plan that I want the clients to take, is this one, okay? And once you've done this, it's really easy. You can go directly to the report selection, pick the reports that you want, and then you can save it. See, it shows you now from net worth, scenario 1, scenario 2, scenario 3, okay? And wealth to heirs, and multiple graphs, bar graphs, and this report, which shows you now cumulative spendable cash flow, baseline, the do nothing, maintain your status quo, they get about 7.5 to spend, which is the total of the 150,000 annual requirements. Okay, doing the Roth, they get the same amount of money, and then doing the insurance, they get about the same. So what we're trying to show is the cost of doing the plan, which is the insurance premium and then the taxes, are not coming out of the spendable. Okay, those are dedicated cash flow, and they don't have to reduce their lifestyle to fund the plan. Okay, whatever lifestyle they need, they are fine, but we're doing asset reallocation to fund the insurance. And by doing the plan, we increase the wealth and we increase the inheritance for the kids. The wealth transfer, net worth, everything looks good. Okay, so and then you have a last report, which is the numbers side by side comparisons. Okay, so that was the preview of the report, and click on done. See, now we've got the 3 scenarios made and the results page. which is the comparison pages. Okay, so this looks really good. I will show you briefly one additional step, okay? And that is, we're going to be copying this one, okay, the third scenario, and make a fourth one. And the reason to do this is basically taking another approach to show to the client the benefit of doing the plan. And it is maybe tailored towards the kind of clients who will say, I'm not really, my top priority is not really necessarily to get as much money to my kids as possible. So their number one focus is what's in it for them. Okay. So the baseline do nothing. They say the kids are fine. They get about 6 million, and by doing the plan, how much of an improvement in terms of spendable cash flow for myself would be. So we're going to add one more scenario to present it in a different approach. Okay, so I'm going to copy this scenario, new, and then I'm going to call this Roth plus IUL plus more spendable or more cash. Okay. So now I'm only making one change, and it's going to be under desired cash flow right here. Okay. And I'm going to add one more entry. So their retirement needs is 150. We saw that. So I'm going to add additional spendable cash. Okay. And schedule. So there is a hidden calculator here. Okay, you can't see it from the main screen. You need to make sure you're in here, add an entry, click on the schedule to activate this pop-up, and then you have this calculator. And it's a really powerful and cool calculator. And what I'm going to do is to use the system, the calculator, to stress test spending down, okay, the assets. So I click on this, and then you get this input screen. You need to define the years for them to get more money to spend, okay? So I don't assume that they're going to spend more money every single year until age 100. And they retire in year 11, remember? Okay, so I'm going to establish the year range, okay? And I'm going to say they do it for maybe 20 years, their golden retirement years, okay? So for 20 years after they retire, how much more money can they get to spend? You can add inflation too, okay? Here I'm ignoring inflation. I want just one even level number, okay? So I don't input anything, okay? Okay, so net worth in year 41. I am going to then use the baseline to input a number. So I'm going to say I want to make sure the kids get the same amount of inheritance. Okay, so I do this. I input the baseline, okay, using, see, you pick the scenario, okay, the baseline, and it shows up. So if we guarantee the kids the same inheritance, then you can now click on the calculate button, and then you see the program says they get about 52,000 per year to spend. Okay, so that's the number. And you click OK, it's going to populate the columns here. Okay, so click OK. And you see here, okay, so now they get an additional 52,000 on top of their 150,000. So they get over $200,000 to spend every year by doing the plan. Click on Done to save, and you see here, this is the fourth scenario we did compared to this one. Okay, it's close. It's due to some rounding. Okay, now I can make a new comparison, and I'm going to call this comparison 2. Okay, and I'm just going to compare the baseline against this fourth scenario. I call this the plan. Okay, and I don't want to add new, so it's only the current situation status quo compared to the plan. Okay, and then you get this kind of report, and you see here scenario 1 versus scenario 2. Okay, and you see here, by doing the plan, they get more money. This is cumulative spendable cash. Okay. Next report. Well, the heirs basically still, about the same out here because that's what we want to do. We want to not spend the kids' inheritance. We still get them the same kind of inheritance or legacy. But see this report. It will tell the story in a nice summary. You do nothing, maintain your status quo. You get about 7.5 million to spend over your lifetime, and you get this kind of money left, net worth, wealth to heirs. But by doing the plan, you get over $1 million additionally to spend and do whatever that you want to do, and you still, pass on the same kind of family wealth. And this is the numbers report. It shows by doing the plan, it produces this kind of spendable income without putting much of a dent into the net worth or wealth to heirs. Okay, so it's a different angle to present the case. It depends on what the client's hot button is. If they care about what's in it for them, more comfort zone, more spending, then it might be more important to show this comparison versus this one. Okay, that's how you do Wealthy and Wise case. Always build the scenarios and then build the comparisons. And when you're ready to present the entire case, you see here, each individual scenario you can print to PDF. So there are 4 sets of individual reports here, plus 2 more sets of comparison reports. So there are a total of 6 different sets of reports, and you don't want to produce 3 or 5 different PDFs and send it to the client. What you can do is to organize the whole thing and use this print, okay? So there's a print that applies to each comparison. There's a print here for each scenario. That's how you print each individual scenario or comparisons. But when everything is all organized and you selected those reports that you want to include, make sure you go through them because there are a lot of reports that you may not want to include. Otherwise, it produces a giant set of files. So here you click on Preview, and then you pick which scenarios that you want to include. And what I want to do is I want to do this, okay? I want to compare the baseline and the plan. Okay, so this is comparison 2, which is a 2 scenario comparison. I'm only comparing the baseline against the final proposal. Okay, Sometimes you may want to do 3 in a different way. So then you may do this comparison and baseline, Roth conversion, and this. That will be another set. Okay. So depending on what you want to do, this is what I want to do. Okay. This one. So baseline versus the plan. And I actually like to put the comparison reports in the beginning, and these are the backup. And you can add a cover page up here. Okay. Make sure you enter all of the information. Select the pictures. You can upload your own picture, maybe the client's family picture. Okay, pick your picture. And then click on this, organize your presentations, add a table of contents, add section pages, and then you can even do your color scheme, okay, if you want to pick your own custom colors. And after all of this is done, you can preview or print, okay, print to PDF, and then you get the whole set of reports in one file, okay. That's how you do your reports.